With the Manufacturing Purchasing Managers Index, or PMI, shooting to 52.6, up from 50.1 in January, it's far exceeded expectations and forecasts and is the highest reading since April 2012. Well, that news sent the stock markets in the region soaring, with Hong Kong's Hang Seng surging more than 4%. Shenzhen, Shanghai both rose around 1%. Dr. Xiaolin Chen is Head of International at KraneShares in London. Welcome to the programme, Dr. Chen. Good to see you. China's manufacturing activity at its strongest in over a decade. Put the figures into some kind of perspective, if you would.
Thank you for having me. Indeed, February's PMI surprised on the upside. Now China is returned to the expansionary territory. It's very good to see both manufacturing and non-manufacturing continue to expand, and now both beat market consensus. It's very, very interesting to notice production activity recovered very, very strongly. New orders, new export orders, even construction, and also you can see some of the service sector also expand very fast. Overall, today's PMI is a signal of growing evidence of China's economy is recovering and recovering very strongly. It lends a lot of hope for a broader and a stronger economic rebound in China.
What do the figures mean for the country's post-pandemic recovery? Are we now in that post-pandemic recovery? Is COVID over? Have we got over it and moved on?
COVID is behind us. I think investors are looking at today's number as a reassurance from China's recovery. And also, I think today's PMI number also serves as a reconfirmation to Chinese policymakers. It reassures investors that China is recovering, rebound very strongly. This is, like you said, is highest number, highest reading for more than a decade. It reassures investors that China has a very unique growth model, which its own domestic economy is sufficient enough to drive China's growth or China's rebound from here. It also, these figures add very strong signals for economic rebound that put the Chinese policymaker in a good position ahead of the National People's Congress. I think now also a reconfirmation thus far for all the policy announced, either COVID relaxation, pro-growth policy directions are all working for the economy.
Let's look more widely, if we might. China needs the world needs China. Is there a concern in all of this that consumers in other countries might be cutting back because of their own domestic financial concerns?
China, last year, investors was largely surprised by how quickly China implemented the relaxation and quickly removed the restriction altogether. It's hugely welcomed by investors globally. And that's why you see some of the sectors in China, for instance, China internet sector, rebounded over 97% from the October of last year's bottom to the peak recently. It is a painful trade for some of the investors, as majority of the global fund managers on average underweight China over 410 basis points. If they look relative performance to their benchmark, it's painful for them to see how outperform, how quick it was. Global managers and investors are learning this in a hard way, that this is hurting their performance, but also they realizing and recognizing China is a strategic asset allocation in their portfolios. But now investors are staying very hopeful as Chinese companies are expecting to deliver strong fundamental earnings, and we expect policymakers to introduce more accommodative policies to help China to meet the needed growth target for above 5% for the next decade. I think investors are looking at the recent pullback as a position, as an opportunity to reposition back to China as an asset class.
Dr. Chen, good to see you. Thanks for coming on the show. Dr. Xiaolin Chen, Head of International at KraneShares in London.